Today we're going to work problem 1125A from page 610. We're doing short-term liabilities this chapter. So those items on the top right part of the balance sheet. This problem has several steps. This first video will do the journal entries, right? Because journal entries always come first. The transaction occurs before anything else. So let's just take a look at what we got. We're journalizing seal and ship, June 30, 2018, end of the company's fiscal year. So we're going to do some adjusting type entries, right, where we're adding some liabilities to the books. All right, and here's the 4 adjusting entries. The first one, the long-term debt is payable in annual installments of $42,000, with next installment due on July 31st. On that date, Seal and Ship will also pay 1 year's interest at 9%. Interest was paid on July 31st of the preceding year. Make the adjusting entry to accrue interest expense at year end. All right, so this is June 30th, and we last paid interest July 31, so that's only 11 months. All right, so I'll just kind of calculate that interest down here. I equals PRT. So that's, the balance of that note is $210,000. See, I'm not using this 42 because that's the payment, the installment. I need the balance. So that's 210. So 210 times 9%, so I write that as 0.09, times 11/12, right? Because it's from July 31st to June 30th is only 11 months. All right, and that's equal to 17,325. So that's an interest accrual. We're not paying cash, right? These are adjusting entries, so there's not cash involved. So we're accruing the interest expense, and of course we'll have to pay it later, right? This whole section is about liabilities, so you know there's going to be a liability in there, right? So interest payable, 17,325. Did you hear that thunder? It's really pouring rain here. I don't know if you can see it, but it's really pouring. All right, back to work. All right, so there you go. That's an interest adjusting entry. You actually already knew how to do that. Interest expense is your debit, interest payable is your credit, and of course I equals PRT to calculate the amount. So let's see what else happens. Next, gross unpaid salaries are $4,700, right? So that's the salary expense we have to pay people. Assume employee income tax withheld are $910, so that's their taxes. We'll have that we're going to have to pay for them. And all incomes are subject to that Social Security. That's what that is. Right, so we'll have to calculate all those. Now, in the book, it teaches you that those items are 6.2% and 1.45%. I would just tell you, if you had to pay FICA, I'd just tell you what they are. But in this case, we'll have to just calculate those real quick, but for you won't have to calculate them. All right, so we're doing our salaries, right? So we're going to have that salary expense, right? We know expenses are debits, right? And then we're going to withhold from the employee. So this is all the stuff that we withhold from the employee, and all that stuff if you get a paycheck that they withhold. All right, so salary expense we know is $4,700, right? So based on this $4,700, we have to calculate that FICA, and OASD, and then we'll have our liability, salaries payable. All right, so the first one is FICA, OASDI, that's your Social Security, and it's, in this book, it's 6.2%, right, times the 4,700, so that is equal to 910, right, that's equal to 910. I'm sorry, that's taxes payable. That's FICA is equal to 291. All right, and then the FICA for Medicare, that is 1.45%. Right, so 4,700 times 1.45 is 68. And then they told us that withholding, so that's the income tax payable. They tell us that's 910. Right, that's what the employees, that's like when they withhold from your paycheck to pay your taxes. And then salaries payable, the part that goes to employees, right, the actual paycheck that they get, is also a liability. And that's 4,700 minus 291 minus 68 minus 910, and that's equal to 3431. So our two liabilities are income tax payable, which we're going to send to the IRS on behalf of the employees. The employees owe it, we're just withholding it. Salaries payable, so that we'll give that to the employees on payday. And these two, Social Security and Medicare, we withhold that from the employees and send it in to them. All right. Now the next thing, record the employer taxes for the last payroll, 4,700. Assume there's no unemployment. All right, so that means as employers, we'll have to pay the same amount. All right, we have to, so whatever employees chip in for Social Security and Medicare, the employer chips in as well. And that's just called a payroll tax expense. And then we'll have FICA, OASDI payable, and FICA, OASDI, not SDI, Medicare payable. And they're the same amount as here. So this is 291. And this is 68, so you add the 68 and 291, and that means our payroll expense is 359. All right, the last thing. Company collected 1 year's rent, 7,200 in advance. So apparently this company, Seal and Ship, rents out some space or warehouse or something, and whoever they rent it to gave the cash in advance, right? So on February, they gave us 7,200, right? And that's what's still on the book, so we haven't done any adjusting entries. But this is the end of June, so whoever gave us that cash up front that we put down as unearned revenue, well, now we've earned it, so we need to get to earn our revenue, right? So we've got February, March, April, May, and June, 5 months of revenue. So 7,200 for 5 months is equal to 3,000, right? So 7,200 times 5/12, so I'll just write it down here. Right, 5 months out of 12. If this was 12 months, we've used up 5/12 of it, so that's 3,000. All right. So if when we earn revenue, that becomes rent revenue, and of course the liability, unearned revenue, decreases. So this is just like any other adjusting entry that you've already learned. What did I say it was? 3,000. Okay, so there we did those entries. We have an interest payable liability now. We have some salary stuff payable now. And we earned some revenue, and so we no longer have quite as much of a liability in unearned revenue. In the next part of the video for this problem, we will go ahead and post these journal entries to the ledger.